My mission is simple, to make you money. I'm here to level the playing field for all investors. There's always a bull market somewhere, and I promise to help you find it. Mad Money starts now. Hey, I'm Cramer. Welcome to Mad Money. Welcome to Cramerica. People make friends. I'm trying to make a little money. My job is not just to entertain, but to educate, teach you. Call me, 1-800-743-CBC. Tweet me at Jim Cramer. On the one hand, the consumer has no problem buying a $3,500 Vision Pro from Apple. On the other hand, the consumer can't afford a Big Mac with fries and a Diet Coke from McDonald's. On the one hand, the consumer is willing to shell out $34.99 for the vinyl version of the Tortured Poets Department by Taylor Swift. But the consumer is also struggling to pay $1.25, the core price tag of something bought at Dollar Tree. How's it possible? And how does it impact our markets on a day like today, where the Dow lost 274 points, S&P declined 0.32%, and Nasdaq dipped 0.20%? Although I have to tell you, at one point mid-morning around 10:30, we were down so much more. The answer, frankly, is pretty stark. It's not one consumer. There are two consumers in this country. There's a consumer who's spending a fortune feeling extremely flush. Then there's a consumer who's extraordinarily pressed and can't afford to go out because prices have gone up too much. It's like we do have two countries here. That's how stark these divisions really are. As long as the wealthy consumer isn't struggling and the cash-strapped consumer remains under pressure, we know that inflation remains a problem. And if inflation is a problem, the Fed is not going to cut interest rates anytime soon, something confirmed by Fed Chief Jay Powell in his appearance on CBS 60 Minutes last night. So if the short rates that the Fed controls aren't going down, there's this difficult reverberation in the bond market that causes longer-term rates to go higher, making everything even more expensive for those who have little money, without really impacting the wealthy. In other words, it doesn't help to raise rates from here. But if the Fed cuts rates and inflation comes back, it's even worse for the consumer. The consumer's in a jam, at least one of the two consumers. It all comes down to the statistics. Take last Friday. We got that hourly earnings from the Labor Department non-farm payroll report, and, well, the wages were up 4.5% year over year. Now, that was more than expected. Robust? Robust enough to rankle the bond market. The combination of higher wages with 353,000 new jobs added had investors furiously dumping bonds, something that sent them down in price and up in yield. That process continued today. Now consider the weaker earnings numbers that we got for today from McDonald's, the one that caused the steady, reliable company stock to plummet $11 to 3.73%. Sure, some of that's about their business taking a hit from protests related to McDonald's because one of their franchisees in Israel offered a discount for Israeli soldiers, not popular in some parts of the world. But there's something else going on, too, something that's indicative of the two-consumer country that I'm talking about. The terrific CEO of McDonald's, Chris Kempczinski, talked multiple times on today's conference call about affordability. You usually don't hear that on McDonald's call, and how the consumer's trading down, even at McDonald's, in part because the companies put through mid to high single-digit price increases to cover their own inflation costs. There's transaction size reductions, too. Think about it. When people are trading down from McDonald's, of all places, you know times are rough for that one consumer. Let me just do the arithmetic. It's very easy. Wages are up 4.5%, but prices are up more than that for many items. So McDonald's customers are driven to lower price items or even cheaper places to eat, like the home. Listen to what Chris has to say, quote, "Where you see the pressure with the U.S. consumer is the low-income consumer. So call it $45,000 and under. That consumer is pressured. From an industry standpoint, we actually saw that cohort decrease in the most recent quarter, particularly, I think, as eating at home has become more affordable. There's been much less pricing that's been taken more recently on packaged food. So you're seeing that eating at home is becoming more affordable," end quote. Tough for the fast food value proposition, good for lower-priced supermarkets. So where else do we see pressure? Hey, Dollar Tree talks about it all the time. There's another outfit that we've historically seen gain during periods of declining economy, but their customers strapped. Dollar Tree recently said that lower-income shoppers are really hurting and are going to their stores to find bargains. But on their conference call, CEO Rick Drelling said, and I quote, and this one blew me away, "In the last 12 months, we have added 4.3 million new customers at Dollar Tree, 2.3 million new customers at Family Dollar." That's another division of theirs. He then went on to say, quote, "Most of these new customers in the past year have household incomes of $125,000, end quote. Wow. $125,000 and going to Dollar Tree. Again, you got two consumers here. You got the strapped, even if it goes up to 125. You got the non-strapped. Did you know that people who earn 125,000 a year are feeling strapped in the country? That's a sure sign that prices really are still out of control, and inflation, while going in the right direction, isn't going fast enough or big enough. Who are the real winners? I think, and I got to tell you, the stocks are telling me I am dead right. There are two winners. There are Walmart and there's Costco. Walmart's the nation's largest grocer. 37 million people shop there every day. Costco covers 72 million households. That's where the trade down is most evident. Now, I don't pretend to have the pulse of prices at these stores, but when I go to my Costco or my Walmart, I am indeed stunned at the rollbacks and the lack of higher prices that I'm now getting quite used to at the larger grocery stores that I go to. I mean, I can see why the CEO of McDonald's means what he says that people are staying at home. These are the places, Costco and Walmart, that are holding the line against all of their suppliers. They're trying to get better prices for you. But what about that $34.99 Taylor Swift vinyl? What about the $35 Apple Vision Pro? You need to understand that that's the other country. Those who are doing very well and everything seems affordable. The ones buying the Vision Pro aren't cash strapped, especially when they can buy this thing using the Apple Card, pay no interest on the $3,500 device over a 12-month period with a 3% cash back up front on the full cost. Apple can charge that much and still get plenty of buyers because lots of people have jobs and, judging by the labor report, can get better ones if they need to. They can get a second one if they need to. I think the rally in Apple stock, it was up almost $2 today, reflects the dawning that the darn Vision Pro might be worth it. Taylor Swift, some would say she's indispensable. I'd say a vinyl Swiftie fan or a CD or cassette fan, yes, she's bringing them all back in at much higher prices than digital, is part of the not strapped economy, the part that can take advantage of the plentiful job market and earn more money without much of a problem. To these people, the Fed leaving short rates higher actually means they can earn more in their savings account. If anything, leaving rates higher for these people longer gives them more spending power. These are the people who can go to Chili's and not blanch at a $15 dinner or a Casamigos Margie for 13 smackers. I love a good Margie, but when it came to charging that at Bar San Miguel, which I used to in Brooklyn, no, would never take it that high. Judging by the humongous numbers we got from Brinker's, Chili's parent company, there are plenty of customers who don't mind, who love paying those prices. All right, let's really go tale of two cities. American Express talked about an 11% increase in dining out, even as McDonald's talks about trading down, which brings us all the way back to the concept of the two consumers. There's a consumer that Jay Powell isn't worried about, the one who can handle the years of rampant inflation we've had since 2019. And then there's a consumer that Jay Powell is worried about, and that's the one who hasn't seen his or her wages increase as much as inflation. No, Powell doesn't want to burn down the economy in order to save it. He doesn't want to throw people out of work to get prices lower. But he's trying to keep prices from going higher for the lower-income people. And if the upper and middle tier want to share in those lower prices or buy the vinyl tortured poets department, well, rock on! It won't be easy to sort everything through. Is McDonald's going to roll back prices? Apple, Dollar Tree, you can revert to $1 pricing or eliminate the higher prices that it charges for a whole bunch of things now. Neither can pull that off without sacrificing their margins and their earnings and their stocks. But what I would say is that they need to look out, because while the Fed can crush many kinds of inflation, the real inflation that matters to everyday consumers, the cost of gasoline, the price of food, well, that's not something the Fed can control. The bountiful Permian Basin is in charge of keeping oil down, while the United States of Costco and Walmart make food affordable for those who can't afford the double Big Mac, let alone the Cramer wife fave Wendy's double Baconator. Please hold the tomato. Bottom line, high rates may not be helping, but they aren't hurting yet, either right now, at least. In the meantime, we've got a bifurcated consumer in this country, and until you understand that, nothing in this market will make sense at all, let alone the inequality that comes with it. Let's go to Ron in California. Ron.
Hi, Jim. Your staff may be the nicest people I've ever spoken with.
Yeah, man, what's up?
Jim, I've loaded up on shares of this company the last 4 months, as I think it is in a sweet spot for infrastructure. It had a top and bottom line beat last week, and the stock popped 12%. It did take some profits. It also raised the dividend 10%. It announced a $1.5 billion buyback equal to 4% of its stock, and coupled with the 1% dividend, that's a 5% return right off the bat. Yet the analysts pretty much hate the stock, and there's a short position of 6%. Am I missing something with United Rentals, or is it a keeper? Thanks.
Well, there is a short position. Now, I cannot in good conscience recommend a stock that really was at $396 in October, is now $645. I could in good conscience recommend the stock, though, if it went below $600. So I am going to be price sensitive and suggesting that that's what you do. Let's go to Stefano in New York. Stefano.
Booyah, Jimmy Chill. How are
Man,
you?
Scott, you have game. I like that. I need some game. It's Monday. It's late. No one's talking. Everybody's like looking down. I'm ready to roll. What's going on?
So this company I'm talking about is beat top and bottom line. I listened to the earnings call, but there's a lot of secret projects, a lot of top secret projects with the Pentagon, Department of Defense. I am calling about the American giant Lockheed Martin. Where is this stock going this year?
Okay, at 3%, I am saying you should buy Lockheed Martin. 3% yield, Jim Takelet. The stock has been a complete bow wow, an absolute dog. But you know what? Takelet's got game. I'm a buyer. Let's go to Robert in Florida. Robert.
Hello, Jim. How are you doing?
I am doing well today, Robert. How about you?
Great. So my question is your take and your idea on biopharmaceutical category, Bristol-Myers Squibb. I seem to be catching the falling knife within the whole last 2 years.
I think that you're catching a falling knife because they do have these loss of exclusivity situations. A lot of their big drugs. I think it's a 5-year plan to turn around the company. It's going to take patience, and you're going to be paid that 5% yield while you wait. I know it's old hat by now, but I still like Eli Lilly. Look, right now we got this bifurcated consumer in our country, but you don't know about it until you dig down into the conference calls. You have to understand that it's impacting the companies you own, it's impacting the stock market in general, the bonds, the Federal Reserve, everywhere. Just think of it as McDonald's versus Taylor Swift. On Mad Money tonight, last week's big earnings report overshadowed an important move I'm seeing in the life sciences space. I'm sharing where I think the core could be headed and the best way to play. Then one of the incredible chartists has spotted an opportunity in a cloud database software company that could have 36% upside. You do not want to miss this one. I'll reveal the name later in the show when we go off the charts. And you stump me with Axum Therapeutics. Tonight I'm turning my homework. You know what? I like it. So stay with Cramer.
Don't miss a second of Mad Money. Follow @Jim Cramer on X. Have a question? Tweet Cramer. #MadMentions. Send Jim an email to madmoney@cnbc.com or give us a call at 1-800-743-CNBC. Miss something? Head to madmoney.cnbc.com.